Hello everybody, I'm Russ Mould, AJ Bell's Investment Director, and welcome to this webinar which will be looking at whether the financial markets are ready to rock or to roll in the coming months and years ahead. But before I quickly dive into the presentation, which I'll try and keep fairly punchy at about 20 minutes, just a few points of order if I may. You are welcome to ask questions at any time during this presentation in the questions box within the control panel on the right hand side. Only we can see them, so there's no need to be shy, and all questions will be answered by email once the presentation has been concluded. If heaven forbid you have any technical problems, please let us know in the questions box. We'll do our best to help. And you will receive an email after the webinar to ask you to fill in an online feedback form. You will then get a CPD certificate and a copy of the session slides via email. In order to qualify for that CPD time, you do have to watch the webinar in its entirety, and a copy of this recording will be available on our Investcentre on our website in the coming days. And just as a final point, we would like to say that the content of this webinar is for a professional advisor audience only. So let's get going. How can we tell if markets are ready to rock or ready to roll? And let's try and cut through a lot of the noise that's out there right now. So we're going to quickly look at 5 good signs, 5 worrying signs, how previous cycles have looked, and draw a few conclusions. So think about the future. If I had a crystal ball, as I would share it with you. Those of you who have had the misfortune of seeing me present before will know that I'm honest enough to know that I do say I don't have a crystal ball, and this is my favorite quote on that subject. It's tough making predictions, especially about the future, and that's from the New York Yankees baseball player Yogi Berra. So obviously what we're going to try and do is, in the end, we have to let valuation to a degree be our guide and look at what's priced in. And that's one of the best ways in which we can try and predict what the future is going to be. But there are nevertheless some positive signs out there, things that have historically boded well for asset prices across a whole range of different asset classes. First one, well, this is the world's biggest economy, the world's biggest stock market, world's biggest bond market, world's reserve currency. And on the face of it, its economy is going absolutely gangbusters. Whether you like Donald Trump or not, the numbers are pretty clear. For the moment, at least, his tax cuts have galvanized the world's biggest economy. We're looking at an annualized growth rate of more than 4% for the second quarter. That's also forecast for the third quarter by the Atlanta Fed GDP Now forecast. And if the world's biggest economy is going strong, there is always the argument that that will lift all boats on that particular tide. The second thing, inflation is relatively tame. I mean, in fairness, it's creeping up, as we can see here in the US and the UK particularly. To what degree that's oil related is clearly an interesting one. The UK has also got the weak pound to contend with, and to be fair, the progress is generally at the moment slow. We know from the experiences of the 1970s that although equities like a little bit of inflation, they certainly don't like too much, and relatively tame inflation is generally seen as a good thing, particularly for equities. It certainly doesn't do bonds any harm, because it means that interest rates don't go shooting higher and drag money away into alternative asset classes, particularly cash, for example. So a little bit of inflation, I think, is welcome. It's what central banks are looking for. It helps slightly nibble away at some of the huge sovereign debts and corporate debts that have been piled up, but we don't want too much inflation. It makes corporate planning very, very difficult. It can chew into profits at those companies who haven't got pricing power, and it can drive interest rates high. So we seem to have a relatively nice, almost Goldilocks type balance at the moment of not too hot, not too cold. Generally a helpful environment for equities particularly. As a result of that, interest rates are rising, but they are doing so at a glacial pace. Even the Federal Reserve, which is looking to press ahead with possibly 2 more interest rate increases in 2018 and 3 in 2019, even that will still get the Fed funds rate to just 3.25%. Nowhere near where it was before the great financial crisis of 10 years ago. And as we can see, if the Fed's moving slowly, the Bank of England, well, is just about moving, and the European Central Bank and Bank of Japan, they're not doing anything at all. And neither of the Europeans or the Japanese are giving any indication they're in any hurry to start raising interest rates, even if the European Central Bank is looking to stop adding to QE from December. And even the Bank of Japan is rumored to be thought of tapering its QE program, although it's given no particularly public indication of doing so. So although interest rates of choice are going up in the West, they're doing so extremely slowly. They're nowhere near levels that you would argue have caused trouble in the past for a variety of different asset classes. Now, cheap money is therefore, and poor returns on cash, historically low bond yields, are forcing money to go looking for alternatives, for options to get a return on cash. It also means that these things can happen. Merger and acquisition activity, share buyback activity, particularly in the US on the right-hand side. The UK is seeing a boom in share buybacks as well. Japan is seeing a boom in share buybacks. And on the left-hand side, that's the total of M&A deals worldwide worth more than 10 billion US dollars. Ka-ching. Why is this potentially positive? Well, in the end, it returns money to your clients. It returns money to the portfolios that you help with, and that money then has to be reinvested someplace else. And lots of people will argue that that is a positive thing. More money to go back into markets, to buy securities and drive prices up. So money is coming back. And you can argue that with US share buybacks in particular, or Japan and Europe, UK, this de-equitization trend, horrible neologism if ever there was one, means there is simply more money chasing fewer shares, with, some would argue, the inevitable consequence, share prices will keep on going up. Finally, earnings momentum. If you look at any particularly major equity setback, you generally need three things. You need lofty valuations, you need interest rates going up, and you need earnings disappointment. Lofty valuations we'll come on to later, but I think it's arguable that we're there. Interest rates undeniably going up, albeit incredibly slowly. Earnings disappointment, no. Earnings are going gangbusters. The UK is showing strong profit growth. Japan is showing decent profit growth in the 8 to 10% range. Asia a little bit quicker. The US, heaven forbid, profit growth year on year up in the 20s and 30s right now. Some of it's tax cut related, some of it's buyback related, but a lot of it is underlying performance related. And it's very hard to see at the moment why the S&P 500 should suddenly crack with earnings going so strongly. Now, clearly the converse argument to that is heaven help us if we get an earnings disappointment, because then things will go from looking very cheap to looking very expensive and having good momentum to negative momentum very quickly. So what you do not want to see at any price is earnings disappointment. The good news is we are not getting that now, quite the opposite. Earnings estimates are in fact not just going, and earnings are not just improving, their growth is accelerating, and estimates are continuing to go up. So if looking for 5 very straightforward positives, particularly for equities, but some of them even bode well for bonds, commodities, they're your 5. Okay, let's play devil's advocate now, switch to the dark side, see what could go wrong, because in the end, we're all in the risk management business. We know that we're all looking to help clients find reward and get positive returns, but equally, we're looking to protect the downside and give them the best risk-adjusted returns that we can relative to the client's particular personal circumstances, strategy, target returns, time horizon, and appetite for risk. So the first, I guess, negative thing you can say is that everything we've just said that's bullish would have applied just as well in 2000 and 2007, at which point everything turned to custard really pretty quickly. And hence Warren Buffett, again, those of you that I'm lucky enough to hear me speak several times will know that I quote him a lot. Speculation is most dangerous when it looks easiest. And certainly one thing that caught my eye very recently, which isn't one of the charts I'm running, US consumer confidence, the US ISM industrial confidence surveys, they're pretty much at record highs. So therefore the first question to ask yourself is if they're at record highs, how can things get better? And if they aren't going to get better, does that mean they're going to get worse? And if they're going to get worse, what does that mean for equities? And this is the kind of market logic that we need to think about, even if it seems a little bit twisted. But speculation is most dangerous when making money does seem easiest. And with most things that are record high right now, maybe that's something that we all need to consider. More tangibly, this is a killer chart. I must admit, if there's one chart that has me lying awake in bed at night, it's this one. We all thought that global debt in 2007 was bad at around $150 trillion globally. It's gone up by about $60 trillion since then, gone up. And the global debt as percentage to GDP is going up. That is not a good thing. Debt is inherently deflationary. The interest has to be paid. It takes money away from where it could be invested in, you can argue more positively, in company capex, company competitive position, R&D, infrastructure, whatever it happens to be. Debt is inherently deflation. It's not bad per se, but certainly if interest rates ever start going up at a speed, it's going to get an awful lot more expensive to service very, very quickly. it may not take a big rise in interest rates to, slow the global economy down, because there's so much more debt in the global system to service. M&A, I've said it can be seen as a positive because it puts money back into institutional investors' pockets, into clients' pockets, into retail investors' pockets, for them to put back somewhere else. But it is the sort of thing that you tend to see near market tops rather than market bottoms when animal spirits are running. And this is a table here that you can see some of this is the biggest M&A deals ever done. And surprise, surprise, they tend to come near market tops. Certainly in recent times, 1999, 2000, 2005, 6, 7. So it is a little bit worrying, you could argue, if you're a contrarian or conservative nature, that the number of mega deals we've seen coming to the fore of $100 billion plus might make you think that, again, animal spirits are running and too much risk is being taken for this. For in the end of cycle, it's now nearly, what, 8, 9, 10 years old. We've mentioned the fact that monetary policy is going up very slowly. Interest rates are going up very slowly, so monetary policy is being tightened very slowly. But there's more to it than just interest rates. Quantitative easing. The US Federal Reserve is actively withdrawing it by not reinvesting its bond portfolio. The Bank of England has stopped adding. The European Central Bank is about to stop adding. Japan is still, in theory, adding at the same pace and is still providing global liquidity. Now, if the Fed stopped adding in 2013, as we can see from this chart here, that did give markets a little bit of pause for thought, using the FTSE All-World as an indicator. And it began tapering in 2015, or 14-15, when we got the taper tantrum. Now, at that point, however, the Bank of Japan and European Central Bank stepped up to the plate, pumped more liquidity back into the system. Now, with the Fed picking up at now, what, $50–60 billion a quarter, a month, I should say, the Bank of England are adding, the ECB stopping, liquidity is being drained again. As we've seen in previous instances, when liquidity has been drained, it's at least given stock markets pause for thought. So this is a potential challenge. If all boats have risen on the liquidity tide, what happens when we start to see that liquidity being withdrawn, which it is right now? And this may be one of the biggest challenges for markets in 2019 and beyond, is this withdrawal of central bank liquidity. It's not guaranteed to have an effect. As you can see over the past few months, it hasn't, but we really haven't gone that fast this year overall on a FTSE All-World basis, and with liquidity withdrawal could be one reason why. So we need to keep a very, very close eye on this. And those grey bars are the year-on-year growth in the aggregate balance sheet translated into dollars of the big 5 central banks, including the Swiss, who were still pumping QE out full tilt to try and get the franc to go down as best they can. As you can see, it's been a big, big slowdown, and that's only going to get more profound. One side effect of US interest rates going up, of the Fed withdrawing quantitative easing, is the dollar is going up. This looks at the DXY, the Dixie index, trade weighted basket, and it's going up. It's not gone up enormously. It's still well less than 100, and is therefore nowhere near the peak that it reached in 2001-2 of 120, miles below the peak of 160 it reached in 1985, for example. But even this small increase in the dollar, perhaps in response to the strong US economic growth, in response to monetary policy tightening of interest rates, in response to monetary policy tightening of QE, the dollar has gone up. What's happened? We have had some chaos. We've had some chaos in emerging markets particularly, but as we can see here, strong dollar generally can mean difficulties for global equities, because the dollar isn't a strong dollar can be seen as inherently deflationary. Because there's so many countries borrowing dollars, the dollar goes up, it makes servicing their debts more difficult. And we've seen how the dollar's gone up, how the debts have gone up. It makes commodities more expensive if your currency isn't linked to the dollar, and so on and so on. So strong dollar, there have been 2 or 3 really big strong dollar periods since Nixon smashed up Bretton Woods in 1971, late 80s, late 90s to early 2000s, both ended in spectacular bear markets. Dollar weakness has generally accompanied big bull runs. So this is something that we do need to keep an eye on. It's not an academic discussion. Strong dollar can be a challenge, particularly for emerging markets. I think it's one of the reasons why we've seen a big rout in emerging markets this year. And don't forget, we've only seen a minor increase in the dollar, a minor tightening of US monetary policy, and you've got the currencies of 5 of the world's 25 biggest economies, all emerging markets, Brazil, Indonesia, India, China, Russia, all trading near Turkey, all trading near historic lows against the greenback. It probably isn't a coincidence that's with just a tiny tightening So what could happen if the US goes further with tightening, which the Fed seems determined to do? Why? Well, it wants to normalise policy. If you look in the past, the Fed has cut interest rates by 5.25% during an economic downturn. It's pretty hard to do that if you're starting from 2%. So they want to get rates up, and that could bring some collateral damage. Valuation. We've talked about higher interest rates. Weight stops trends. Higher interest rates eventually stop markets. We've talked about earnings momentum being positive, which is great. Valuation is a matter for discussion. It's easy to argue that global stocks are cheap looking at 1 year or 2 year forward earnings. Even the US at 16, 17 times is only trading slightly above its long-term averages, nothing to panic about. But if you look at, but that is based on current operating margins, which are at peak, based on current profits, which are a peak of GDP. So the question is, what happens if we do get an unexpected downturn? Things won't look cheap and they'll suddenly unravel very quickly. Robert Shiller, again, this is not to everybody's taste, and we know that Mr. Woodford rubbished this analysis at the Investable a couple of years ago. But Robert Shiller looks to cyclically adjust valuations for earnings over a cycle, for interest rates, for inflation. And on the Shiller multiple, US equities have only been expensive 2 or 3 times more in their history. 1929, 1999, those are episodes that, as we all know, did not end well. So yes, we can argue that US equities in particular are cheap on a 1 to 2 year earnings basis. But if operating profits normalize either because of inflation or because of wage inflation or an expected downturn, then we have a potential problem. So it's tempting to argue stocks are cheap because at the moment earnings forecasts are positive, momentum is strong, earnings are at all-time high and expected to go higher. But how long can they keep going up from an all-time peak is a question that we need to address. We are in a bull market, and I like this one from Sir John Templeton. Bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. So really what we're probably looking for is how much euphoria is out there. And to be fair, it doesn't feel like there's lots. This is known as a hated bull market. Lots of advisors and clients distrust it because of the role that central banks and QE and zero interest rate policies have had to do with it. But we have begun to see some blow-ups where there has been, you could argue, certainly plenty of optimism, if not some euphoria. You've already seen cryptocurrencies blow up, low volatility strategies blow up where people were shorting the VIX, and emerging market currencies we've discussed have blown up, and emerging markets have fallen from favour. And this is classic of any bull market. When risk appetite begins to ebb, it ebbs from the periphery first, the most extreme areas where people wouldn't normally play, but they've been tempted because money has been easy, they've been tempted because gains have been good, or in this case, they've felt obliged perhaps by poor returns on cash, QE, and zero interest rate policies. So you could argue we're already seeing the early stages of risk appetite withdrawing from the periphery. The question we need to ask is if, when, and how does this reach the core and start to create more pain in core central markets? This is just me being a little bit cheeky. I hope the two gentlemen on the right hand side have absolutely done their pieces. But taking risk is very popular until it isn't, as Arthur Miller wrote in The Crucible. Until an hour before the devil fell, God thought him beautiful in heaven. It doesn't take much to persuade people that what they thought was a good thing at one stage is not such a good thing at another very, very quickly. So where do I think, and this is just a personal opinion, it's certainly not anything that could be seen as advice, but it may help me frame some discussions with clients. Where right now do we think there's pessimism, skepticism, optimism, and euphoria? Pessimism, and in some cases, it could well be perfectly justified. Bricks and mortar retail, real estate investment trusts. Sterling's down on the floorboards right now, which I think is inherently interesting. Again, UK priced assets, they don't look expensive on the PE terms. Property doesn't look too bad on the yield terms, and you've got a cheap currency, potentially interesting. Nobody's talking about gold or precious metals. Emerging markets are now in the doghouse, bonds in the doghouse, value investing out with the washing, value fund managers still finding life very tough to attract fund flows. They, to me, are areas that are probably worthy of further research, even if some may be in the doghouse for a long time and deserve to be there. Others, I'm sure, will re-emerge at some stage. Skepticism. Bank shares have been horrid performers this year, which is interesting if everybody keeps telling us the economy is going well. Japanese equities, Abenomics, people still aren't sure whether it's a runner or not. Cryptocurrencies now subject to some skepticism, which is probably a good thing. European equities, lots of worry still over Italy in particular. Income investing has been tough this year. You've had lots of high-profile dividend cuts in the UK. income funds have found it very tough after there's been a huge dash for income over the past few years. Optimism, the dollar, oil has bounced back, developed market government bonds, the yields are still pretty tight, quite frankly. Residential property, everybody seems keen on that. And growth investing very popular still. Euphoria, Chinese web stocks have cooled off, and it's interesting that Jack Ma is now looking to retire from Alibaba, which may be a masterpiece of timing, but the FANG stocks are still going bananas. Facebook, Apple, Alphabet, Netflix, and Google, or Amazon, Netflix, and Google. Small cap biotechs going tonto, investment grade bonds look a bit pricey. Index proliferation for me is very worrying. There are now more indices than there are individual stocks, which means while we love passive investing as a potential low cost tool, you still need to think about what you're investing and getting exposure in is the right thing, not just because it's low cost. And momentum investing, incredibly powerful still, hence the FANG's predominance. But without those, US equities wouldn't have returned much this year, and without US equities, global equities wouldn't have returned much this year. Areas where people are still pretty hot and bothered and don't seem too worried about price, they're probably the ones that you think at some stage, because of the very popularity in very valuations, are where perhaps the risks are greatest, even if in the short term the returns look the best. So in conclusion, real bear markets, certainly in equities, need rising interest rates, lofty valuations, and earnings disappointment. We do have the former, albeit slowly. You could argue we have the middle bit, but not if you believe that operating margins, company operating profits will stay at peak or improve from here, which they might. But we certainly do not have right now earnings disappointment, but it will obviously be the catalyst if we do. There are some signs of excesses and froth, but equally some of those have been blown out this year. Cryptos, low vol, emerging markets, and it's certainly arguable that 2000, 2007 were worse, if not dafter. Certainly the Schiller multiples got to certainly at similar levels, and if nothing else. But again, we need to be on our guard. We are perhaps seeing a slow move of risk away from the periphery. We need to check, could that get to the core? And the reasons, if it does, they're the reasons at the top there. So in sum, risk is clearly the management, that we're all in the risk management business. The question is, do we now want to take more risk, the same risk, or less risk? I think given that we're seeing moving it away from the periphery, I think taking more would be a brave call right now. We probably are entering a sort of cycle where we need to start thinking about what could go wrong rather than just what can go right. And I think therefore calibration of portfolios is probably a sensible plan from here. But again, that is down for you and your individual clients and their personal circumstances to work out what's best for them on a case-by-case basis. So we certainly can't give a blanket analysis. But I would say if you're looking for what can go right and what can go wrong, the 5 things we've discussed here will be a pretty good starting point for any discussions you wish to have with clients going forward. Thank you very much for your time, and we look forward to receiving your questions, which we'll gladly answer as best we can.